Morning, everybody. What we're going to be going through this morning is basically just a quick look at some of the issues that are affecting audit and compliance of self-managed super funds as a result of the coronavirus. So I'll commence by actually spending a little bit of time just looking at the various announcements, giving you a bit of an update on where we are, particularly with the rent deferral that the government's announced and what we need to do with that. And it's probably become a little bit clearer that, in fact, assuming that the vast majority of arm's length arrangements between tenants and landlords is seeing some form of accommodation being entered into, failure of a self-managed super fund to do likewise could actually result in gnarly. So it's not a case of whether you need to reduce it, but rather whether you're exposing yourself to an extra tax liability if you don't. So we'll get to that, and then we'll finish off with some just basically planning issues, because markets go up, markets go down. The reality is that there's opportunities in movements in either direction. And I just wanted to point out to you where I see some opportunities, given that markets are certainly continue to be lower than they have been in the past. So what are we going to talk about? Well, first we've just got to move excuse me, that's not coronavirus, it's just a cough. Some housekeeping issues. So basically, type your questions into the chat box and I will attempt to deal with them as we go along. If we don't deal with them during the presentation, there'll be an email prepared which will go through those. The slides themselves are attached to that in the handout section of the webinar on the right-hand side of your screen. So just click on that if you've got anything or you need to download them. You will receive a post-session pack which will include those same slides, a recording of the session, and then access to other presentations that we've given. And finally, but not least, if you've got any issues, please just type in that support@goto.com webinar and you'll get some assistance with everything that we need. So basically, we've got half an hour, or that's the aim. And so we'll move through things reasonably quickly. I did touch on some of these changes in my last a webinar that I did probably about 3 or 4 weeks ago, and also in the specific SMF update webinars that I give on a paid subscription basis. So, and they were done in a little bit more detail, but we'll touch on them again just to make sure that everybody is well aware of what they are and how they work. Certainly in our case, we've been through and we've contacted all of our clients that are in pension mode, and to the extent that they are an account-based pension or a market-linked pension or a transition to retirement pension, we've informed them that the minimum pension withdrawal basically has been halved. So the next slide that I've got will indicate exactly what those rates are, and the halving of that pension requirement is for the 2019-20 and 2021 years, and it would, depending on the speed with which the economy recovers, I would not be surprised to see that that period of halving of pensions is extended further than those 2 years. That was certainly the case with the GFC. It went on for 3 or 4 years, and then rather than taking it straight back to the standard withdrawal rate, it was phased in over a year or two. So there will be those continued concessions. You'll note there at the bottom, there's a number of pensions to which the halving does not apply. The reason for that is that basically the contracts that are entered into with complying lifetime life expectancy and flexi pensions is basically a contract between the member and the trustee, under which the investment risk sits with the trustee. Now, this is one of the reasons why these types of pensions actually can't be provided from self-managed super funds anymore, because of the liquidity risk that actually sits with the trustee itself. But effectively, what the member has entered into with these pensions, I should say, is that the income stream is effectively a guarantee by the trustee and not based upon the assets which the trustee holds. Indirectly, the trustee, of course, has a pool of funds and generally speaking has a reserve of such a size to enable to give these guarantees in the first place. But it's not an account-based pension. The income stream is not based on what is actually invested for that member. Rather, it's a mathematical formula contained in the contract that was entered into when the pension commenced. And for that reason, and given that, and probably the second aspect of it is given self-managed super funds no longer provide those sorts of pensions, the government has seen fit not to include them in the reduction. So, as there's not very many of you that have probably got these pensions, I think we can probably move on from that, but it's just be aware of the distinction. It is straight 50%. There's no change in the maximum withdrawal. So that is relevant for your transition to retirement. You're still able to withdraw what you want. And if you've got the cash flow or your own concerns about the length of time for which your money will last, then you've certainly got the ability to be able to withdraw the benefits on a timely basis. This slide here is basically just outlines what those reductions are. Now I did, you don't need to be a genius to actually work that out. Couple of things I just wanted to touch on briefly, which I have touched on previously. If you've paid more, so as of the 24th of March, the pension requirement dropped by 50%. So if your pension previously was 50,000, after the 24th of March, it was 25. However, if you've paid $30,000 before the 24th of March, at the time of that payment, your minimum pension payment requirement was 30,000, and there is therefore no capacity for that excessive $5,000 as it is now to be returned. You can, of course, take it, receive it, and put it back into the fund as a standard contribution, but that assumes that you're eligible to make the contribution in the first place, which may or may not actually occur. And the other point that I wanted to make is that after sorry, I just lost my train of thought there. After the 24th of March, given that you have reduced your pensions, so say from 50 to 25, if Peter had actually paid or was looking to pay, say, $40,000 out over the period, and up until the 24th of March, has paid 25, it's got an additional $15,000 to pay. The question is, how do you deal with that $15,000? And the answer is that provided you've got appropriate documentation in place, which the member and the trustee entered into, which basically said that payments in excess of the minimum can be treated as partial commutations, then in that case, that $15,000 that is paid after the 24th of March will be treated as a lump sum withdrawal and not as a pension payment. The advantage of that is that it reduces, given that this pension is likely to be a retirement phase pension and therefore has been measured against the transfer balance cap, the partial commutation of that pension will reduce will give rise to a debit against the credit when that pension was commenced, thereby opening up some space for future contributions or accumulations to be moved to pension mode at some point in the future. So I'm hoping that that's clear. Payments above your minimum, where they're made after the 24th of March, can be treated as partial commutations, provided pension documentation was entered into by the member and the trustee prior to the date of payment. And if that is the case, that would require a transfer balance cap notification reporting to occur, whereby there would be a debit that would be applied against the member's transfer balance cap, opening up space for future accumulations to be able to be applied to that particular member. And finally, this partial commutation here So you've got a minimum pension of 50,000 paid 24 before the 24th of March, 30,000 is now reduced. Can we repay the 5,000? No. Can additional payments be made? Yes. There's no change to the maximum. Can additional payments be commutation? Yes, provided the documentation is in place. So that's what that's dealing with. Okay, direct property. The issue here is all around the rent, okay? And we have had quite significant clarification from the ATO that for the 2021 year, there will be no corrective or compliance action taken by the ATO where fund trustees enter into arrangements with related parties to reduce or defer rent where that has occurred as a result of COVID-19. There's been a downturn in the business and the turnover, and the arrangement is temporary. So it can be deferral, it can be waiver. There's a number of choices that you can actually enter into. They've also stated that where the property is held through an underlying unit trust, they would expect that no compliance action would be taken in those circumstances either. So that's good news. It certainly provides us with some certainty over what we need to do. And in fact, as I said right at the beginning, I don't think it's a case of whether entering into one of these arrangements, temporary arrangements, is going to give rise to NALI. In fact, I think it is probably there's a fair chance that not entering into one of these arrangements where landlords and tenants in industries similar to yours are universally adopting that approach, and the SMF fails to do so, that is likely, potentially more likely to give rise to NALI than actually implementing it in the first place. I hope that's clear. If it's not, just type a question in, and I'm happy to answer those as we go along. So, what are the types of factors you've got to take into account? Well, you've got to basically, you've got a written lease agreement. It's not going to alter the existing rights and obligations. There should be some evidence that the tenant has actually requested the relief and outlined the basis, therefore, their turnover has fallen by 64%. Also needs to be evidence in writing that the landlord themselves have agreed. And as I've said, it could be any one of these types of solutions that are actually implemented. So it could be deferral, whereby there's not actually going to be any payment of rent for the period up to, say, the 30th of September, because that's the period under which the JobKeeper provisions are going to apply. So there might be, we don't pay any rent for that period, but we then add the unpaid rent to subsequent rent payments made thereafter. Maybe it's an additional $500 a month or whatever for 18 months, or who knows what it might be, but it might be something like that. You may waive the rent, so there's actually no requirement for it to be paid at all, or depending on the size, the amount of the downturn in the turnover of the tenant, then you may just reduce the amount of rent that's payable, say by 50% if there's been a 50% downturn. But it's up to the trustee and the landlord to negotiate those. But provided what is being negotiated is in line with what everybody believes to be arm's length arrangements, then that is not going to give rise to any real issues going forward. The same thing applies actually where we've got a commercial property owned by a self-managed super fund and we've got a limited recourse borrowing arrangement in place. Obviously, the banks have made clear that they will look at deferral, they will look at waiver, they'll look at reductions depending on the circumstances of the tenant. The fact that your tenant is unable to pay their rent and there's been some sort of form of arrangement entered into on an arm's length basis means that will flow through to a potential arrangement between the SMF and the borrower in line with what you would expect to see in a commercial banking arrangement. And the banks are actually entering into arrangements where there are loan repayment pauses or repayment holidays, which either result in a deferral or a waiver or a reduction of interest, etc., that would take place. And once again, the ATO has confirmed that there will be no compliance action taken in these circumstances. So that's hopefully that provides you with some guidance with regard to that. So I've had a couple of questions, just broadly speaking, with regard to property. I had a question yesterday actually from a fund auditor where they talked about a business that had a turnover reduction of 54%. He was obviously concerned about the arm's length requirements. The reality is that businesses out there are entering into these arrangements where those sorts of circumstances arise. It's not going to be a breach of the nullity provisions. It is not going to be a breach of the arm's length requirements. And the ATO has made it clear that provided you've got the evidence in place, they will not be taking compliance action either. So I think it's fairly straightforward. We can get caught up in technical issues, that are supposed to make life, that could make life a little bit more complicated. But I think really everybody understands where we are at the moment, and that we just need to move forward. Okay, early access. Look, the ASIC has actually amended its legislation to enable accountants to be able to provide advice on this. The SMF Association has put out and it's got a draft of a record of advice that they suggest would be appropriate to give to a member who was seeking advice with regard to this. I think you've still got to be very careful if you are not licensed about the type of advice you're giving, and I think that in most cases it's probably far more likely that an accountant that is not licensed is going to provide factual information about the process, because the process is actually relatively straightforward where you meet the criteria in this instance. Having said this, I don't think this particular measure is something to be encouraged where there are other solutions available for clients. The fact of the matter is that if you've got a 25-year-old that withdraws $20,000 from their super fund, everything, and empties out their super account, that will have a net $120,000 to $150,000 impact on their ultimate retirement benefits. And it's quite simple. That is the compound interest on $20,000 for a 40-year period will push you up to that 160, 170 mark, and it really will have an impact on what they ultimately retire on. So while it eases this particular situation, or can do in certain circumstances, it's not without consequence, and members need to be aware of exactly what that is. So just be careful of that. Having said that, there are 695,000 withdrawals that have been lodged with various public offer funds, according to APRA's figures released yesterday. Of those, they have dealt with roughly 180,000. So there's still a lot more money to come out. So far, the average withdrawal is $8,000. Given that the maximum amount that can be withdrawn before the 30th of June is $10,000, one would assume that that is because there are people applying that don't have $10,000 in their super in the first place, and they're simply emptying their accounts. So there will be an issue there. It's also fair to say, with regard to this particular measure, that there's been a fair amount of pressure placed on the superannuation funds to pay them out on a timely basis. They're not entitled to seek any additional evidence other than what is provided as part of this mechanism. But it's also fair to say that some of them may well be facing cash flow issues if they've got large numbers of their members with low balances or looking to clear their benefits out within a very short period of time. So it does have a consequence, in potentially triggering fire sales as well. So let's just quickly go through exactly what the rules are here. Members are able to access $10,000 for the 1920 year and for the 2021. So that's not 1221, it's 2021. I've just noticed that. And up to the 24th of September. These payments are tax-free and they won't affect Centrelink or Veterans Affairs. So putting the extra cash in your hand won't apply, you are now currently able to apply. So I said mid-April there, these applications have been made and they are being processed. It is a relatively straightforward process. It's done through MyGov on the website. And basically you are entitled to 2 applications, one for the 1920 year and one for the 2021. It's $10,000 per application. There is no more than 2 applications. If you decide that you are only going to withdraw 7,000 instead of 10 before the 30th of June, you can't go back and apply for the extra 3 at a later date. The applications have got to be made before the 30th of June and before the 24th of September to be valid for those particular periods. And the funds themselves are actually going to report this information in their annual return. So it is something that will be able to be looked at and measured. So that's a little bit of detail, 10,000 in this financial year and next. So pretty straightforward. Will make a big difference, I would imagine, for a lot of the low income earners if they've got that money. While I've said that I don't think it's a great idea for long-term retirement purposes, it clearly puts them into a position for at least the next 6 months whereby they should have sufficient to support themselves if they're already on a job seeker or job keeper payment. So that's something to bear in mind. So what entitles you to actually ask for this money in the first place? You're unemployed, you're on job seeker or new start, or on or after the 1st of January 2020, you've been made redundant, or your working hours have been reduced by 20% or more. Now, just with regard to this 20% or more, the one point I wanted to make here is that I've had a couple of questions, and I don't have a firm answer because I am not an employment lawyer, but there are quite a few employers out there who have entered into arrangements with their employees by which their hours that their employees are working have dropped by 20%. BDO, many of our team members are working 4 days a week when they used to work 5. That's a 20% reduction. But that doesn't necessarily qualify these people to go and ask for money from their super funds, because while we've actually entered into arrangements under which they are taking unpaid leave, we actually have not, in my view, and this certainly needs to be qualified. So if you've got clients that are covered by this, make sure you get proper advice. But in my view, we haven't reduced their hours. Their hours are still 35 hours a week. We've asked them to work 28, which they are doing, and they are taking 1 day in unpaid leave. But their overall hours are still 35 hours a week. So just be careful of that one. It's not completely clear to me that would otherwise satisfy that criteria. There's also special rules around the self-employed and sole traders. So on or after 1 January, their business is either in hibernation, so their personal trainer that ran gym classes in their garage, and they can't do that anymore because of the hibernation and the social distancing, or their turnover is reduced by more than 20%. So in many cases, or in most cases, the tests for that 20% reduction are going to be very similar to those that would be applied to the job keeper provisions. So we've got a quick question here. What if the loan increases as a result of the rent deferral and the continuation of interest? My view is that the ATO is not going to take corrective action or compliance action with regard to any increase in the loan amount. There is, I think it is a good question that you've raised, because if you don't pay the interest, then it's just deferred and it's going to be included in later repayments. Is that a new loan? I think potentially it could be argued that it was, but they are not going to take any corrective action. So I think that you'll find that is okay. I think that provided you are entering in, I think what you do need to bear in mind is that you need to act in accordance with what is an arm's length arrangement, and in similar circumstances, what would be occurring as far as the bank is concerned. Would you be going to them and asking for them to reduce your interest rate, etc.? If that is the case, then I certainly think that you're able to do so with this particular fund. I'll just get rid of that. Actually, I can't get rid of it. That's okay. We'll add that to the list of questions that go on after the session. So investment strategies. I just wanted to quickly touch on a couple of things here. Has the trustee reviewed the investment strategy? So we've all got these letters that we've received from the ATO back in September 2019, where they said that they didn't like the fact that everything was in cash, or everything was in term deposits, or everything that was in property. Okay, we never got the letters with regard to cash or term deposits, but we certainly got them with regard to property. The reason we got them is because, in fact, there is a view within the ATO that many funds investment strategies do not accurately reflect what the investment strategy that's been adopted by the fund. They talk broadly about having ranges of investment classes from 1 to 100%, and they talk about risk and diversity, and yet they've got no diversity. So what the ATO wants to see with investment strategies going forward from an audit perspective is an investment strategy that does actually reflect what the fund is actually doing. So if it's only got property in it, state that it's only got property in it, but state why it's only got property in it. That you believe that farmland, for example, will increase as the increasing Earth's population requires sustainable protein into the future. That might be the reason why you've got nothing but farmland inside your superannuation fund. You should not take into account assets that you've got outside. The issue is you've got a fund. The fund is required under the investment rules to put together a strategy that considers risk, return, diversity, liquidity, and also whether insurance is warranted. You have to deal with those things in your strategy. Have a look at your client strategies. If they don't deal with that, it is time to consider reviewing them. That might be something that is difficult if you are not licensed, or that you can have discussions with regard to broad investment categories. It may be that you can sit down with your client and say, you've only got farmland. Why have you only got farmland? Okay, well, you need to draft that into this strategy. If they won't draft their own strategies, you need to get somebody else to do it if you can't do it yourself. But auditors are finding that when they are being reviewed by the ATO, the ATO is specifically looking at investment strategies and the types of tests that they're doing. And if they accept your broad strategy that it doesn't really reflect what the fund's investment strategy is, they will find themselves in trouble themselves. So it is an issue that is not going to go away. From the point of view of COVID, a lot of the falls in investment markets may well have made your investment strategies inaccurate anyway. They no longer are appropriate. They would potentially need to be reviewed at that stage. So the question is, does it comply with the current strategy? I also think that, given that it may well take quite some time for there to be a recovery in investment markets, you do need to consider, particularly if pensions are being paid, whether you're holding sufficient cash. Do you have enough cash to pay the next 2 years' investments? I should say the next 2 years' pension amounts. If you don't, that would potentially mean that you would need to liquidate some assets. Do you really want to be liquidating assets over the next 2 years? Have you really got any idea which way markets are potentially going to move in that period? If you don't, then potentially you are looking to hold a greater proportion of your investments in cash, which will give you the security to be able to meet your liabilities as and when they fall due, and of course is in line with the investment strategies that you're looking to apply. So it's got to be a positive cash management position that you're actually looking to implement. talking about the auditor says, what is the strategy at the 30th of June? Should the strategy have been reviewed post-COVID? Does it refer to all of the SIS requirements and give effect to a focus on investment return and diversification? Has the trustee given effect to the strategy? Does the strategy identify the risks of a lack of diversity and why the strategy is nonetheless appropriate, or if it's not, what changes need to be made? So they're the issues there. If an auditor comes across a circumstance where they find that a strategy is not in compliance and they raise it in year one and it is not addressed by year two, then potentially you are looking at penalties. And the ATO, in their investment guidance on this issue, has said that where breaches do occur, penalties of up to $4,200 can be applied. So here's something that you do need to look at and pay particular attention to. A couple of other points I just wanted to make. So we're up to 10:30, but I should be able to finish in the next 10 minutes or so. But a couple of other points just with regard to audits. So fortunately for us, okay, so we've got a fund and it's got an in-house asset, and the market value of that in-house asset as at the 30th of June 19 was 5%. It had 95% of its assets basically invested in the share market, and the share market's fallen by 40%. So as a result of the fall in the value of its share market investments, the market value of the in-house assets now exceeds 5% of the overall market value of the fund as at the 30th of June 2020. The fact that it exceeds 5% at the 30th of June 2020 does not give rise to a breach. The concessions that have been given to the ATO mean, though, in the normal circumstances, had the in-house assets exceeded 5%, you would need to put in place a plan to reduce the level of in-house assets to less than 5% by the following 30th of June 2021. The ATO has basically said that they will not take any action if a plan has not been executed because markets have failed to recover in that period. So basically, yes, they acknowledge a breach has incurred. Yes, they acknowledge the next step was that a plan be instituted over the following 12 months under which the in-house assets be reduced to less than 5%. But if markets have not recovered sufficiently to enable that action plan to have been implemented, they will not take any corrective action. And I think that provides a fair degree of comfort as far as clients are concerned. The final audit issue is that, and we have been doing this since COVID became apparent, so probably any audits that we completed since February, we have included a subsequent event balance date, which basically that note recognises that we didn't know and don't understand the full impact of the pandemic, and we still don't at this stage, but it will have some impact and therefore needs to be taken into account in the reading of the accounts. So all of our systems have been amended. Any auditors that we are dealing with are insisting that we have one of these minutes or notes in our accounts, and it is one of the things that you need to take into account. There's a question here, question 2, same as, well, okay, so we were talking before about the deferral of interest, okay? So what should the auditor be reporting? Well, if the auditor is looking at somebody who's entered into, so this is a question number 2. If an auditor is looking at an arrangement whereby a fund has borrowed money, but because the rent that they are receiving from their arm's length tenant, say, has been reduced, they don't have the money to pay the interest. So they go to the lender which is related and they implement the same arrangements that are being entered into by the banks with their arm's length lenders. If the same arrangement is entered into in the same circumstances, I don't think the auditor is reporting anything. There is no breach of the in-house assets rule. Sorry, there is no breach of the arm's length requirements, there is no gnarly. In fact, the problem may well have arisen had there been no reduction in that interest rate, given the circumstances that surrounded that fund. So there's a degree of judgment that needs to be applied here, but the fact that there has been a change to an arrangement does not necessarily give rise to a breach. I don't know whether that helps. I hope it does. But if you need more information, I'm happy to try to provide that to you. Okay. A couple of points, just some planning issues. And many of you are probably not aware of this, but within a member's interest within a fund, we have a taxable interest and we have a tax-free interest. Okay. And when there are movements, so say we've got $1 million, well, actually, say we've got these numbers here. We've got Bill, and Bill's got, he's age 55, and he's got a super benefit of $1 million. And here's the taxable component of that is $350, and his tax-free component is $650,000. Okay. Now, his interest falls by $500,000. So share markets fell generally by about 35%. He's had fared a little bit worse because some of his stocks weren't quite as robust or as evenly spread right across the market, and that's made a big difference to him. So his interest has now fallen to $500,000. If he was to transfer that benefit to a new fund because he is unhappy with the investment selections being provided, say, by Australian Super in this instance, and I'm just making that up, and he transfers his account balance out of Australian Super and into another fund, what will go across is $500,000. But as markets start to recover, every dollar of earnings that is derived will be treated as a taxable component. So he'll end up, assuming that the markets, the account balance ultimately returns to $1 million. At that stage, his tax-free component will be $500,000 in the new fund, and his taxable component will be $500,000. Why the difference? Because you can't transfer the lost component of your tax-free component from one fund to another. So it is one of these things is just worthwhile bearing in mind. Should I actually stay, were the investments that I invested in good investments? Am I just subject to the same movements as everybody else is in these circumstances? If I maintain my investment and it recovers within the same time as everybody else, the first $150,000 worth of my contributions and earnings, so this is not just earnings, but also contributions, will be treated as 50 tax-free in that circumstance. It is only once the interest reaches 650 that it will actually start to give rise to a taxable component. So do I transfer? Don't I transfer? One of the issues that you need to consider. Okay. The other thing that we can think about too, with regard to smaller balances, is that it is easier to equalise them out. Okay. And it might also be easier, so what I mean by that, okay, there's a whole range of thresholds that are measured against our total superannuation balance. So this includes, can I actually carry forward and contribute unused concessional contributions from prior years when my balance is, my total superannuation balance is less than 500,000? Or can I make further non-concessional contributions because my total super balance is now less than 1.6, or it might have even dropped down to 1.3, which means I can put $300,000 in. Is it less than 1.6 so I can segregate my assets? Is it less than 1 million so that I can actually report annually for TBAR purposes as opposed to quarterly if it was above 1 million when my pension commenced? All of these, is it less than 1.6, which means that in the event of my death, I can transfer my full pension account across to my spouse without resulting in any benefit having to be paid out as a lump sum. does it, do the amounts that I hold in accumulation that have fallen now mean that I've actually got greater capacity to roll all of my benefits into pension mode, unlike I did before, so that all of the future growth in that will actually be derived tax-free. All of those issues revolve around or rotate around the concept of, is my balance less than a certain amount, thereby enabling me to take advantage of certain concessions? One of the other steps that enables you to take advantage of those concessions, of course, is to make sure that you've equalised account balances between husbands and wives. And one mechanism to do that is to split your concessional contributions between your husbands and your wives. So the point that I would make here is, yes, we've all had a fall in the value of our clients' superannuation benefits. If we now introduce a strategy such as superannuation concessional contribution splitting, potentially we'll be able to put our clients into a better position to be able to structure their retirement as they go forward. So you need to bear that in mind. Here's a quick example of the effect of splitting a contribution for a member. Both these guys, Jake and Rose, are under the age, I should say, are under the 1.6 mil threshold. We're taking $25,000 from Jake's account after it's been contributed and giving it to Rose. It just pushes the benefit up a little bit. The extra benefit that you get also applies here with cash out and recontribution strategies. Basically, once again, you've got Jake here not in a position to make any further non-concessional contributions. These balances may be after the fall that's arisen as a result of COVID-19. We then take a transition to retirement payment of 10% that's not been reduced under the pension reduction rules and contribute it for Rose. Okay, so 1.6 is 160,000. 160,000 comes out, Jake's age over 60, so therefore that withdrawal is tax-free, goes into Rose's account as a non-concessional contribution. Her balance was less than 1.2. We've now very much brought those balances under control. So why is that a strategy that we don't use more often? Have you discussed this with your clients? So if you haven't and you don't feel comfortable about it and you know that you're not licensed, then perhaps we can assist you in that area and make sure that in fact you're taking advantage of all the chances that you've got. So the cash out and recontribution strategies: withdraw unrestricted benefits and recontribute them, commence a TRIS and recontribute. And what it does is it helps as far as in all of these arrangements, but basically the ability to make helps with the ability to make non-concessional contributions, the ability to segregate your assets, utilise that 5-year bring forward, and retain as much of your super inside your superannuation fund as is possible. So that just brings us to the end. We've probably about 45 minutes. It's not too bad. There's a disclaimer. So I've sort of given you lots of general information, but nothing specific for your clients. As is always the case, we're happy to help PPN members. I am a licensed advisor and able to help with people who want to pull their money out of super, but also if you've got clients that actually have decided and you are not able to assist them yourselves, have decided that they're going to use COVID-19 as a reset, get themselves back on track, put in place a plan that will ensure that they end up where they want to end up, then I'm happy to talk to them on your behalf. And it will be dealt with in the normal standard way that all PPN arrangements are dealt with. So thank you very much for your time. I'll just wait and see whether anybody else has got any more questions. Maddie, are you there? We might close the session down in a moment. And thank you very much for your attendance.